Picture this, you're in your early 60s, ready to retire, maybe you've even saved a few $1,000,000, and you're looking forward to the next phase in your life. So you roll your 401k over to an IRA to start taking your withdrawals, and life is good until you remember something. You owned stock in your company in your 401k, and there was a strategy that you didn't know about, one that could have saved you tens of thousands, maybe even hundreds of thousands of dollars in taxes. This strategy is called Net Unrealized Appreciation, or NUA, and most people haven't heard of it. I'm Nick Sapienza, Senior Advisor at Ritholtz Wealth Management, and this is Ownership by Ritholtz. Today, I'll show you how NUA works, when it makes sense, when it doesn't, and how to know if it belongs in your plan. But there's a catch, actually several catches. Get the timing wrong, miss a requirement, or bungle the math, and you can end up paying more in taxes instead of less. So let's jump in to see if this is the right solution for you or if you'd be better off without it. Starting with the big picture, equity is a growing part of the way that people are compensated. According to Vista from 2021 to 2024, the percentage of HR leaders who reported offering equity-based compensation rose from 65% to now 76%. So knowing the ways in which you can reduce the taxes that are due on your equity-based comp is critical. NUA sounds complicated, but the idea is simple. It can help you pay less in taxes and gives you more flexibility with how you're taxed on withdrawals in retirement. Here's how it works. When you leave your job, the IRS normally treats your whole 401k the same. You can roll it into an IRA, and later, every dollar that you take out is going to be taxed like income, just like a paycheck. But with NUA, company stock gets special treatment. Instead of rolling everything into an IRA, you transfer the company stock into a regular investment account. Now, why would you want to do that? We know that whenever you take funds out of your 401k, you're going to be hit with taxes. And you're right, but with an NUA strategy, the IRS splits that company stock in two. You pay income tax only on what you originally put into the stock, what you originally paid for. That is what we call your cost basis. The growth above that gets taxed later at long-term capital gains rates whenever you decide to sell. For most people, this is 15%, and in many cases, that's substantially lower than what they might pay in income taxes. The main idea here is that the 15% capital gains rate is lower than your income tax rate at the time that you withdraw. You're trading a high tax rate today for a lower tax rate in the future. Think about that. You've worked hard for this money, and NUA is a way to keep more of what you earned and pay less to the IRS. And this brings us to two paths. Path one, the rollover. You move everything into an IRA, later every dollar is taxed as income. And then there's path two, the NUA. You move the company stock into a taxable account. You pay income tax, like we said, only on the cost basis. Meanwhile, the rest of your 401k, the things that were invested in target date funds, mutual funds, and other types of products, rolls into your IRA. That's the big idea. Two paths, two very different tax bills. Now let's look at some numbers, because this is where NUA can save you a fortune or end up costing you more. Here's an example when NUA wins. Let's say that you have $1 million worth of NVIDIA stock in your 401k. You paid $200,000 for it. That means you've got $800,000 worth of growth. With path one, the rollover, you move it all into an IRA. Later, every dollar is going to be taxed whenever you take it out, like income, at a 24% tax rate. That's about $288,000 in taxes. Now, we are making some big assumptions here. We're assuming that every dollar is taxed at that 24% rate. That may or may not be the case. And we're also not accounting for any growth in the stock. We're just trying to make a very simple apples-to-apples comparison. Now with path two, the NUA, you move the stock into a taxable account. You pay income tax on only the $200,000 that you put in. That's about $48,000. The $800,000 in growth is taxed at capital gains rate, so that's about 15%. So $120,000. All in all, that's $168,000 in taxes. And again, that's when you decide to sell the stock, not that you would sell it all in 1 year. But when comparing both scenarios, that's a tax savings of about $120,000. Same stock, just a smarter choice. Or we can consider this client, we'll call her Mia. Mia retired from Apple in 2010 with $200,000 of Apple stock. That cost her $75,000. If she'd used NUA and held the stock, that position would be worth over $1.6 million today. Her tax savings, well, that would have been in the hundreds of thousands of dollars. This strategy worked really well for people who held, of course, Apple and NVIDIA stock through major run-ups, but this isn't always a slam dunk, so let's see when it doesn't go so well. NUA can be a disaster in two situations: when your cost basis is too high or when your company hits a rough patch. So let's flip the numbers. Let's say that you have $500,000 worth of company stock, but this time your cost basis is $400,000 and your gain is only $100,000. With path one, the rollover, you put it all into an IRA. Later, every dollar is taxed like income. At a 24% tax rate, that's about $120,000 in taxes. With path two, the NUA, you move the stock into a taxable account. You pay income tax on that $400,000 cost basis. You're probably going to be bumping tax brackets at that point, and that might be, let's just assume, $96,000 in taxes. The $100,000 in growth would eventually get capital gains tax treatment, so let's just assume that's 15% or $15,000. Now, you might still come out ahead in this scenario, but it's way too small of a margin to be worthwhile, and this is assuming that you have no other earned income in the year in which you do this. So in any event, it's probably not a good idea. It's probably best to roll it over, and then when you're in a low income year in retirement, stack Roth conversions on top of your withdrawals and fill up a tax bracket and get your tax-free money that way. Now, on the other hand, there's the company risk. And here's the reality of how this can go. Imagine that you retired in 2016. You worked for a company for 30 years, and along the way, you accumulated their stock. You've had an amazing run, and you've actually accumulated the bulk of your wealth from this company, and you feel really confident about their future prospects. But unfortunately, over the next few years, the stock craters. In fact, it falls 80% from peak to trough. Having such a large portion of your money in that stock hurts bad enough. The upfront tax cost would have just been salt on the wound. Now, if it sounds specific, this is because it is. It's a real conversation that I had with someone that was unwilling to sell and unwilling to diversify. The stock was GE. Luckily, the stock recovered, but you couldn't have known that in real time. You couldn't have known that a new CEO would come in 3 or 4 years later and turn the company around, and the stock would then be reaching new all-time highs. Either way, over that 9-year period, it's probably not worthwhile to keep so much money into that one stock anyway. But many times this doesn't actually happen. There isn't a big turnaround. In fact, according to JP Morgan, about 40% of all companies that have appeared in the Russell 3000 index since 1980 have suffered a catastrophic decline, one that they define as a 70% or greater decline in the stock price from its peak, of which they never recover. We've seen this happen many times. Think about Enron, Lehman Brothers, Sears, or even think about Microsoft, which took 16 years to reach new all-time highs after the dot-com bubble. I show you this not to scare you, but to create awareness, because you can't be a good investor without being a good historian. The lesson here is that NUA amplifies both gains and losses. If your company takes off, you've added fuel to the fire. If it struggles, you've paid unnecessary taxes at the worst possible time. So here's a quick rule of thumb to help. NUA will only help if the tax savings on the gain outweighs the extra income tax that you pay on the basis today. Now that's obvious, but it's helpful to say the obvious part out loud. And here's a simple test that you can do. If your basis is more than 3.5 times your gain, NUA probably isn't worth it. In a good case, you have a $100,000 cost basis and a $300,000 gain. NUA saves you money in taxes. In a bad case, you have a $400,000 cost basis and a $100,000 gain. NUA likely costs you money in this scenario. At its best, this strategy saves you money in taxes and adds flexibility in how you tax at retirement. That flexibility always comes at a cost, but there are ways to manage that upfront tax hit. So let's look at that next. One of the biggest worries with the NUA strategy is the upfront tax hit, but there are smart ways to make it easier. First, you can retire in a low income year, or you can wait to do the NUA strategy and take any money out of your 401k until the following tax year where you're not showing any income. Secondly, you can cherry pick the lots, and this is huge. You can use partial NUA for your most appreciated shares, which will reduce the size of your cost basis and therefore your tax bill. 3, you can offset gains with tax loss harvesting elsewhere. Here at Ritholtz, we have a solution called custom indexing, which allows us to pass along tax benefits to our clients through routine stock market volatility. Number 4, you can give to charity. If you already give, you can donate appreciated stock instead of cash. No capital gains tax, full deduction, and you can even stack multiple years worth of deductions into one tax year to reduce that tax bill. You can do this by using something like a donor advised fund or a charitable trust. But there's one more, and it's huge. It's called a tax paid balance. And according to Bogart Wealth, it is possible to apply any after-tax or tax paid balance toward the cost basis when you take your distribution. If, for example, you have a $100,000 tax paid balance in your retirement account and you apply it to the $100,000 cost basis, your income tax, which otherwise would apply to the cost basis, would be eliminated. The rollover would then be tax-free. But ultimately, if the numbers don't work for you, then skip NUA and roll it into an IRA. Then when you're in retirement and you have this lower tax window, you can ladder withdrawals along with Roth conversions to create your tax-free money that way. So that upfront tax bill doesn't have to stop you. If you plan ahead, you can make it much smaller. And speaking of taxes, there are always rules to follow and hidden costs. So let's talk about those next. Before you make any decision, there are a few critical rules you must know about net unrealized appreciation strategies. Number 1, triggering event. You can use NUA only after leaving your company, turning 59 and a half, death, or disability. If you were to do NUA before 59 and a half or even below age 55, because you could enact the age of 55 rule, you would be subject to a 10% penalty. Now, if you're 43 years old and you have a cost basis of $45,000 and you've got a gain of $300,000, it might still be worthwhile for you to do the NUA and just accept the 10% penalty. I know I probably would. So that's not the end, but it's just something to be aware of. Number two, you must take out the entire 401k in one tax year in a lump sum distribution. The NUA stock goes out to the brokerage account. The rest is rolled into your IRA. And number three, post-distribution gains start a new clock, which means that you transfer this money to your taxable brokerage account, your regular brokerage account, whatever you call it. Let's say that you have $400,000 in that account. A month later, you have $420,000. That $20,000 portion is on a new capital gains clock, which means if you sold that portion less than 12 months, you would be subject to short-term capital gains tax. If you waited until after 12 months, you would then qualify for long-term capital gains tax, which would be lower than short-term capital gains tax. And number four, there is a slight inheritance quirk when it comes to NUA. Your heirs actually don't get a step up in basis on the NUA gain, so they would still be subject to capital gains. This is different from a regular stock that you would own and have large gains in. Your heirs would get a full step up in basis, meaning that they would inherit that stock. Let's say that you had $1 million of gains in Apple stock. They would inherit that stock tax free. Then there's the hidden costs that make NUA or high basis NUA especially worse. First, you have IRMAA surcharges, which means that your Medicare premiums can jump from the 1-year income spike. Then you have phase outs on certain deductions like QBI, itemized deductions, credits that can all be triggered by bunching that income into 1 year. 3, sequence risk. Now, we did a full video on sequence risk. I highly recommend you checking that out. But if you have a particularly volatile stock and you're trying to reduce your exposure to it, or you just need to diversify, you want to factor that in, that you may be in that first year, along with the cost basis taxable income, that you may also be liquidating some of that stock at long-term capital gains. But one important note, not a hidden cost, but actually a hidden benefit. The gains portion, the NUA portion, is not subject to net investment income tax, so that saves you almost 4% in taxes. Either way, there are always trade-offs, so let's talk about what they are. Here's the pros and cons of an NUA strategy. I'm gonna start with the cons first. First, taxes will be owed, so it'll remove a good chunk of assets right away. Then you're also out of the tax-deferred wrapper, so going forward, capital gains and dividends will become taxable. Next, as we mentioned, you don't get a step up in basis, and it can bump tax brackets and increase Medicare premiums and phase you out of other deductions. But on the other hand, it can save you tons of money in taxes. Those savings stay in your portfolio and compound over decades. So factor that in as well. If I saved, in our previous example, $120,000 in taxes, that stayed in my portfolio. That grew at maybe a 7% rate for another 10 or 20 or even 30 years. What is that total impact? That's something that's really important to calculate whenever you're making your decision. And then, of course, it helps you fund near-term cash flow needs at a lower tax rate. It lets you trade ordinary income taxes for long-term capital gains rates. So here's the trade-off. It's a decision to pay some taxes sooner rather than paying more taxes later over time. And to summarize, let's walk through a simple checklist. NUA usually works when you have 4 things. 1, a low cost basis. Number 2, a large gain. Number 3, a relatively manageable tax bracket. And number 4, you just simply want more flexibility of how and when you pay taxes, and you think that there is some arbitrage between the rate that you're paying now, the rate that you'll pay in retirement, and what capital gains rates may be at that time. On the other hand, NUA usually doesn't make sense if you have a small position, or if your tax bracket is going to be the same or lower than the prevailing capital gains rates, unless you can qualify for 0% capital gains rates. Then you may still want to consider this strategy. And then if your cost basis is too high, you can bump brackets and you can find yourself in a much higher bracket. So you need to factor all of that information in when you're running your numbers and trying to make this decision. In short, NUA shines when you have big gains in a company stock and you expect your tax bracket in retirement to be higher than the prevailing capital gains rate. Of course, this checklist won't give you the final answer, but it shows which side of the fence you're likely on. Now let's zoom out, because NUA isn't just about taxes, it's about the bigger picture. It's about control. It's about giving yourself flexibility. That flexibility always comes at a cost, but in many cases, it's worth it. So the question isn't just what saves me the most in taxes today, it's what gives me the most control over my retirement tomorrow. Now that you know how the NUA strategy works, the next question is, what other mistakes should I avoid with my retirement accounts? And if you have company stock in your 401k and you're wondering if NUA makes sense for you, well, that's exactly what we help clients figure out here. Watch this video next, the top 401k mistakes people make, because when you pair that with what you've just learned about NUA, you'll be 10 steps ahead of most retirees. There's a link in the description if you'd like to connect with one of our advisors. And if you found this helpful, like and subscribe. I'm Nick Sapienza. This is Ownership. Thanks for watching.